Hey everyone, welcome to this new and exciting webinar all about income, AI, and growth. If you like income, you're in the right place. If you're looking for something more capital appreciation, AI themes, well, now is better than ever to talk about these stocks, specifically with how the market has pulled back a little bit. We like to say when markets pull back, that presents buying opportunity. So we're going to hear from Stephen Cress, our VP of Quantitative Strategies here today. Thank you so much for taking the time to hang out with us. We're going to be doing more of a marathon on this one. We're going to go past our normal allotment of time. Make sure we try to get as many questions answered at the end of today's webinar for you all. It can be about Seeking Alpha's products. It can be about the picks. It can be about our portfolios. Whatever questions you have, we are here for you today. But before we dive into the picks and speak with Stephen, let's go ahead and get our quick legal disclaimer out of the way. We are not advising you personally concerning the nature, potential value, or suitability of any particular security. You alone are solely responsible for determining whether any investment, security, strategy, or any product or service is appropriate or suitable for you based on your investment objectives and personal and financial situation. This presentation is for information purposes only. Content is presented as of the date published or indicated and may be superseded by future events. It represents my opinions and Stephen Cress's opinions, which may not reflect the views of Seeking Alpha as a whole. Past performance is no guarantee of future results, and Seeking Alpha is not a licensed securities dealer, broker, U.S. investment advisor, or investment bank. All right, and with that out of the way, the man, the myth, the legend, the quant titan himself, everyone, Stephen Cress, how's it going today?
Dale, I'm doing well. Thank you so much for organizing this. I think it's incredibly timely. With the markets pulling back a little bit, what a wonderful opportunity to pick up some great, high quality growth names, but at the same time, pick up some dividend oriented stocks as well. So we have a nice balanced barbell approach there between income and growth. So I
That's
really
a
do
good point,
appreciate you
Steve.
organizing it.
Yeah, and talking about AI, right? Maybe you've been watching all the headlines like I have, whereas, Nvidia earnings are this week, but also you're seeing these large cloud infrastructure deals happening and people are worrying about debt loads. And there's so much confusion going on in the space right now. So I'm so glad that we were able to grab time with you today. But for the people that may not know who you are, Steve, can you give us a little bit of background of how you got to Seeking Alpha today?
Yeah, absolutely. So I've been in the world of finance for close to 35 years, with the bulk of my career working on Wall Street and also in the city of London. Most of my tenure was at Morgan Stanley. I worked there for 13 years, where I ran a prop trading desk in quantitative strategies, but I was also the founder of a quant hedge fund, as well as a fintech company that Seeking Alpha purchased. And that's what has brought me here today. It was really one of the first systematic trading models created for the use of individual investors. And it's been a terrific ride, and we have some great products and just a great quantitative system here at Seeking Alpha. So periods like this where the market comes off, we could be really timely with coming through with some great recommendations.
That's right.
Yeah. So I might as well say the presentation today, it's going to cover why quant. It's going to cover the market pullback and fading rate cut hopes. We're going to discuss the market rotation that's occurred over the last 5 days in the case for income stocks, as well as the case for AI growth stocks. I often refer to this sort of as a barbell approach. When we hit periods where the market pulls back, you definitely want to own stocks that have good fundamentals, but you also want to get paid to wait and take advantage of any income-oriented stocks that have come down in price and get yourself a little bit of a higher yield. So it's a wonderful opportunity when we have dips like this. And that's what we will be covering today. First off, though, Day, I'll tell you a little bit about why quant and how it differs from what you might consider traditional fundamental analysis. And really, quant is not that much different than fundamental analysis, especially the way we do it at Seeking Alpha. For the most part, it is a data-driven process. So we're using mathematical models, algorithms, and we use that towards identifying stocks. And when we look to identify a stock, this is where we actually really use traditional fundamentals. And at Seeking Alpha, our strategy is a GARP strategy for quant, which is growth at a reasonable price. And there's a couple extra things that we look for. We're looking for momentum, and we're looking for positive analyst revisions on stocks as well. So when we add it all together, that is a diversified strategy that we employ. Many analysts that work at firms such as Morgan Stanley or Merrill Lynch or Goldman Sachs are also fundamental analysts, and they're looking for companies that offer good value and growth. The big difference is, though, as an individual, and having been an analyst myself, you're really only capable of maybe covering 15 to 20 stocks. Typically, you have a sector focus. And when you actually have to write about those stocks and put pen to paper and analyze the stocks, maybe you're lucky if you can update all 15 or 20 stocks once or twice a month. The great thing that we have in terms of quant is the ability to use the power of computer processing. So when we take those conventional fundamental investment characteristics and we add the power of computer processing, it gives us the ability to go way beyond covering just 20 stocks and providing a directional recommendation that's updated once or twice a month to doing it every single day for thousands and thousands of stocks. So we're really using the same fundamental characteristics that an investment analyst would. It's just we're using the power of computer processing, which really puts analysis on steroids. And it's because of this that it gives us the ability to provide a fresh recommendation on each stock on a daily basis. And part of the power of our quant system is also to provide our users with, when they look at those investment characteristics, such as value, growth, or profitability, they'll get an instant characterization of where companies stand on those metrics versus competitors. And as we get into our platform, I'll be able to showcase that a little bit more. So that's really our quant system. It is fundamentals in terms of its analysis, but it is the power of computer processing on top of it. And we have, as you can see, a pretty good track record. It actually goes back to 2010, but no need to go back that far. If we just look at the most recent 5 years, you can see if you took a look at all our quant strong buys every single day, and you measured it against Wall Street strong buys every single day over the last 5 years, you can see our quant system is up 219% versus Wall Street, which is just up 33%. And for the same period, the S&P 500 is up 64%. So Wall Street analysts and their strong bias has actually underperformed the S&P 500 significantly, but you can see the quant system easily crushes both. So right now, what I'd like to do after showing you that performance is sort of discuss a little bit of the pullback that the market has experienced, and also cover fading rate cut hopes, which really acted as a very strong catalyst to help the market rally over the last couple months. So volatility has returned to the market to the levels that we saw really back in the first quarter. And much of that, the recent volatilities were on the back of the shutdown and valuations that are pretty extended, and a lot of investors not necessarily feeling comfortable with the overvaluation that we've seen in some tech stocks and AI stocks. So Q4 opened with a heightened volatility as the government shutdown hit. And that was despite having pretty solid earnings from many companies in the third quarter. The shutdown lasted from October 1st to November 12th, and it was one of the longest government shutdowns ever. And it really triggered a sell-off not only in the market, but more so in stocks that were overvalued. So we really noticed with companies that were AI-oriented, data center-oriented, and even the Mag 7 stocks really started to come down, more so in the last 5 days than even over the last month. The market optimism that we had in the previous month, did fade pretty quickly as the shutdown really got into sort of its final stages, and there was still a lot of uncertainty. Thankfully, that is going to be over, and employees of the government will be paid again, but it did hang over the market as it extended into the later days. So sometimes a picture is worth 1,000 words. So I actually want to show you what the performance of various sectors look like. This is sorted on a 5-day basis. So we show the returns today and the returns for the month. But if you look at the center, you'll see 5 days, and that's where it's sorted. And I think that picture perfectly tells you like what has happened and the opportunity that we could have off of this dip over the last 5 days. You can see the worst performing sector is financial services and consumer discretionary and technology, down anywhere from 3.5% to a little bit over 4%. The mega cap tech stocks that previously led the rally really have lost steam over the last 5 days, with the exception of a couple that did well today. The rate sensitive sectors have also suffered on fading rate cut hopes. And really what we were experiencing over the last several months was a continued optimism that the Fed would continue to take interest rates down. However, some of the data that has come through recently has the Fed a bit nervous, and they're leaning towards more of a hawkish outlook than they had in previous months. And we'll be able to see that in a couple slides coming up. So as a result of all of this volatility and the concerns, there's been a rotation into defensive and cyclical stocks, which are typical safe haven stocks, and cash as well. And that's why we have noticed energy, utilities, and consumer staples outperforming the bottom part of this table, which are technology, consumer discretionary, and financial services. So rotation to safe haven stocks. And you can't blame people. They're seeing headlines like this in the morning. People really focus on the tech sector with an extended sell-off. AI bubble fears are in the spotlight, and that's really sort of like the spear that is leading the sell-off. And there are other headlines too. This morning we saw S&P futures drop for a fourth day. Of course, as tech shares slump, but also Bitcoin has now broken below 90,000. We haven't seen those lows since April, and it's pretty much washed out the gains that it has had for 2025. So a lot of reasons that the market continues to be volatile. And also on top of that, the valuations, which are really at 5 and 10-year highs. So the rate cut debate and the data deluge that's ahead. So we have had basically a freeze period on data during the government shutdown. A lot of that data is going to come out. And since there's uncertainty over that data, that has also contributed to a reason why the market has been a bit volatile. If you look at the right-hand side, you'll see this is the Fed Speak Index, near the most hawkish in a month. So you can see really, if you look back to around September 25th, and then even in early November, people were very optimistic that the Fed was going to continue to take rates down. However, really, in the last 2 weeks, there's been a lot of nervousness, especially as Fed Chair Powell has spoken. Some of the other Fed governors have spoke. And they're showing continued fears about inflation. So one of the reasons why the Fed took rates down was that there were concerns over the labor market, and that was weakening. The situation that they're in now is that they face the weakening labor market, but they're also facing sticky inflation as well. And the Kansas City and Boston Fed chiefs, Jerry Schmidt and Susan Collins, both mentioned further cuts could stall that 2% inflation target. And that's one of the reasons why interest rate traders are not quite as optimistic that the Fed will be taking rates down. Perhaps if we did see firmer job growth, that could limit the easing prospects. So there's a number of reasons there why individuals and traders are fearful. And here are two great charts. One on the left-hand side was really from November 6th. And at November 6th, you could see 70% of interest rate traders expected a rate cut in December. Fast forward to today, where we're looking at that same metric, only 53% of traders expect a rate cut in December. So not only are you hearing it from the Fed chiefs, but you're hearing it from a lot of traders as well, that concern is out there that interest rates may not come down. Again, only 52% of interest rate traders now looking for a rate cut to take place in December.
Steve, it's worth mentioning here as
Yeah.
well. Like all of this is tied to that lack of government data that we haven't had during the government shutdown. And the days ahead, they're going to be releasing tons of data that is going to be taken into the consideration by the Federal Reserve, but also all of these traders out there. So you may see a 50-50 right now, and bulls and bears may be fighting it out, but in a week or two, we might be stabilized.
Change. You're absolutely right. That definitely could change. And it's typical of how uncertainty plays into the market. Uncertainty is the biggest negative influencer on the market. Like if you have a lot of solid bear indicators, usually the market will factor that in really quickly. If you have a lot of bull indicators, the market continue to rally. But what really can get to the market is just uncertainty. And that you just nailed it right on the head with that. A lot of data is going to come out, and nobody really knows what's going to come out of that data. So it could change. Very, very solid point. Thank you. So the AI trade, what are we seeing here? Markets moved into extreme fear territory. If you look on the chart from CNN, they have a fear and greed index, which is actually really useful. And more often than not, actually, what I have found historically, when you're in extreme fear territory for a while, that actually ends up being a good buying opportunity. Now, just a week or so ago, we were in fear and it's moved to extreme fear. So I'm not sure how much more the market has to the downside, but clearly that fear is being reflected. We're seeing that in the market levels and we're seeing that in this index as well. Um, a softer labor market could anchor expectations for rate cuts, reigniting investor appetite for growth stocks. So we did see, it's kind of weird, obviously not good of labor data softer, but if the labor data is softer, it provides more incentive for the Fed to lower interest rates. Obviously, we're seeing a pullback now, and a pullback could ease valuations, offering more attractive entry points. And one thing I will highlight with a number of the AI stocks that we're focusing on today, they have already experienced a pullback, but they have very strong fundamentals. And that's why we're focusing on those names. And also, there is some confidence out there. A lot of people, are fearful that we're in an AI bubble, but there are many investors who think AI is like really in its initial stages. And Buffett today took a new position, not today, but he's just recently built a new position worth $4.3 billion in Alphabet, signaling his confidence in AI from one of the market's, more conservative and cautious investors. So really good to see him investing into Alphabet in this period. So AI stocks with strong fundamentals and durable demand will remain well positioned for a long recovery. And that's where we would encourage you to sort of purchase on the dip. Now, I also say when you have a dip in the market, it's also a great opportunity to pick up dividend stocks. And there is a case for quality yield. So strong labor data may reduce the likelihood of near-term rate cuts, adding uncertainty to equity markets and pressuring growth stocks. So it'd be nice to have a handful of dividend-paying stocks there. In volatile environments, investors often rotate toward dividend stocks with reliable earnings, steady cash flow, and attractive yields. And quality high-yield dividend stocks can provide stability by offering predictable income and more stability compared to the broader market. So I often will use these periods where we have a dip in the market to purchase stocks that I think are attractive on fundamentals and have come down. But also, since there's uncertainty, as Daniel sort of alluded to before, we really don't know what's going to happen with the data. It's probably a good opportunity to pick up some stocks that have a higher yield, but quality high yield. So here's the case that we're making for top income and AI growth stocks that are worth watching. And I'm going to start with 3 income stocks. So the first stock that I'm going to put forward is Merck, ticker symbol MRK. It's a strong buy. And the healthcare sector ranks 8 out of 976 stocks. And within its industry, which is pharmaceuticals, from a quant standpoint, it ranks 3 out of 177. And also has a whopping yield of 3.49%. So I think most people are familiar with Merck. It is one of the largest pharmaceuticals around. But Daniel, you said earlier today there was some news. Stock is up. So why don't you share with us the news that's out there on Merck today?
Yeah, stock is popping. It's north of 3%. Earlier in the day, it was trading 5% higher. This is off the back of a mid-stage trial that resulted favorably. So you're seeing some momentum in the stock today. Some nice purchase power, 4.5% as you see here now on the webinar. But again, momentum is going to start building. Strong buy. Steve, why don't you walk us through the metrics of what you like about this one?
I will. So even with a stock rally like this, we still like it. As you can see, it has a quant strong buy. And if you're not familiar with the system, this is a rating summary card. We actually show 3 independent sources there. We take the consensus of the Seeking Alpha contributors and what their recommendation is, and that's consensus is a strong buy. Wall Street consensus is a buy in the stock, and the quant directional recommendation is a strong buy, and that is based on the factor grades that we see underneath. Now, these factor grades are all sector relative. So I mentioned earlier, the platform is really good. This is the premium platform. And when you look at those factor grades, it gives you an instant characterization of where the stock stands versus the sector. So when you look at the valuation, you can tell it's attractive versus the sector. When you look at the growth, you can see it's very attractive versus the sector. And in terms of profitability, it's one of the most attractive in the sector with an A+. So I'm going to click on the valuation grade. We're very transparent, so we want you to see what that is comprised of. And just some great, data points in terms of the valuation framework. If you look at the forward PE, it's very cheap at 10.3 times. The sector is at about 18.9 times in terms of that forward PE. So it's at about a 45% discount to the sector, hence the A minus grade. If we were looked at the PEG, which is one of my favorite ratios because it combines both PE and growth together, it has an A minus, and the PEG ratio is 1.1 versus the sector at 1.7. So that's at about a 34% discount to the group. And you can see we have a lot of metrics that we use here for valuation. There's EV to sales, EV to EBITDA, price to sales, price to book, price to cash flow. So we're not using just one valuation metric. We're taking a number of valuation metrics, and that is what gets us the overall value grade of B. If we were to look at growth, you can see the revenue is pretty much in line with the sector with those C minus grades, but you could see the bottom line, which when we're looking at EBITDA, EBIT, or EPS, it is far, far stronger than the sector. And if we look at the EPS gap growth estimate, it's 297%. We use Wall Street consensus for our forward numbers. So the model is historical looking and forward looking. And for the forward looking, when we look at either revenue or EBITDA or EPS growth, we're getting that from Wall Street consensus. And you can see it's just so much stronger than the rest of the sector, hence that A growth grade. And in terms of profitability, you can see just terrific numbers. Gross profit margin, 77% versus the sector at 59%. Net income margin, 29% versus the sector, which doesn't even hit 1. If we look at return on common equity, investment banks would love to have an ROE like this. It is 39.5% versus the sector, which is actually negative 34%. So just some really great metrics for Merck. And of course, it has this incredible dividend with a yield that's 3.49%, almost 3.5% based on yesterday's closing. And if we scroll down, we're going to look at dividend grades. So dividend grades are really unique to Seeking Alpha. When I joined Seeking Alpha, I found that there were a lot of investors who liked income and focused on dividends. And there's really not any good platform out there that can really showcase dividend data and tell you if a company has a good dividend or a bad dividend, if it's safe, is it growing? So we immediately created dividend grades. And the dividend grades aren't there for the purpose of capital appreciation. For capital appreciation, we're looking more to the factor grades, which lead to that overall quant strong buy. But the dividend grades give us a sense of, is there protection there? And I will show you what this looks like. So we actually provide a little bit more information on how the dividend grades work. And if we went back to 2010, we would find that 98.77% of dividend cuts were averted if you owned a stock that had a dividend safety grade of A minus to A plus. Pretty much actually A plus to B minus, 98% of dividend cuts were averted if you had a stock that had that grade. Conversely, if you had a stock that had a dividend grade of C plus to F, we found historically that 93% of all those companies had cut their dividend or eliminated their dividend. And we also found that 70% of all stocks that had a dividend grade of F had cut their dividend. So that's a really, really powerful grade to assess. And if you have stocks that have dividends, I would highly suggest that you upload them into our portfolio tool so you can look and see what those dividend grades are. And if we look at dividend safety, I'll click on that. You can see what the underlying metrics are. So we have a host of underlying metrics. We can see Merck has a dividend safety grade of A minus. So that definitely puts it in the safe territory. A couple areas where you might see some D grades, but there are quite a few where you see A's. And that makes all the difference in the world for our dividend stocks. So if you're looking at net income margin, or you're looking at cash per share or cash from operations, if you're looking at sustainable growth rate, these are all very positive metrics for companies. Interest rate coverage is very important as well. You can see it's an A minus there. So lots of good metrics that make that total dividend safety grade. Daniel, I'm going to take us back to our presentation.
Yeah, while you do that, I think it's also worth mentioning that the dividend grades, that back test that we just showed you about the 98% not having to cut their dividend and the 93% that usually do cut their dividend or eliminate their dividend, all of that data was compiled between Seeking Alpha and S&P Global. So this is a outside vendor helping us run those back tests, validate the back test to showcase that we're not just trying to say, you know, within Seeking Alpha, we have a model that fits our narrative, right? We are using outside data sources. I just wanted to highlight that, Steve. I don't know if there's anything you wanted to
No, I'm
that.
glad you did. It's important to know that it's sort of independently vetted, and the data is outside of Seeking Alpha as well. We collect it from S&P, and they're basically taking the data that comes from the SEC. So that's really worth mentioning. And I guess something I should mention too is if you owned dividend paying stocks that had a strong buy quant rating and had an A plus dividend growth grade, this would be the performance from 2010 through today. And you could see it would be up 744% versus the Vanguard Income and Growth Index, which is up 522%. So I consider that a benchmark because that owns a vast amount of stocks. And this would be a vast amount of stocks as well. But again, rebalancing it every single day, you could see quant strong buys plus dividend safety grade growth grades of A plus prove to be very, very valuable in terms of the return. So going back to our presentation, we highlighted a lot of the great data points for S&P. It's cheap. It's really good growth. Excellent interest rate coverage. So I think it really sells itself in terms of one of the dividend stocks that we're focused on. Now, going to REITs, a lot of REITs have terrific dividends as well. This one is called Alpine Income Property Trust, ticker symbol PINE. It's on the small side with a market cap of 252 million, but it is a quant strong buy. Within the real estate sector, ranks 9 out of 172 stocks. And within the industry of diversified REITs, it ranks 1 of 12. This has a whopping yield close to 7%. It's actually at 6.94% right now. And they own and operate a portfolio of 128 commercial properties across 34 states. So you're getting a lot of diversification there. Current occupancy is 99%. With 48% investment grade tenants. So very, very strong diversified REIT. In terms of some of the data points, looking at price, the AFFO, it's at 9.1 times. It's about a 40% discount to the sector. In terms of its forward AFF grow, it's at 9% as well. And that's a 277% premium to the sector. So in terms of valuation, cheaper than the sector. In terms of growth, stronger than the sector. In terms of profitability, its AFFO margin is 48%, which puts it at a 19% premium to the sector. And it has 11.5% dividend growth rate for a 5-year CAGR. So that's huge versus the sector. I'll take us to the platform so we can take a quick look at Alpine. And you can see Seeking Alpha contributors. The consensus there is a strong buy. Wall Street, the consensus is a buy, and Seeking Alpha Quant has a strong buy on it. Year to date, the stock is actually down 1.37%. So it really has not done much. But if you take that 7% yield, close to that 7% yield, that is a very attractive yield to have. And perhaps, with the market being weak, this is a good opportunity to take advantage of it, even though the stock has come up recently. Back to our presentation.
I'll say the thing I like to see when we talk about these ratings, Steve, is when Seeking Alpha analysts in aggregate also have a strong buy rating on the stock. It kind of gives that extra level of a little bit of validation almost of, if you're on the site and you go to the quant back test page, if you wouldn't mind real quick, under the quant ranking card, Steve, on the right-hand side.
Okay.
Click on the REITs quant ratings beat the market, I think it is.
Yep.
Sorry, this is the wrong one. But if we'll pull it up in a second on the next symbol. If you actually look when Seeking Alpha analysts give that strong buy rating in aggregate, which they are very reluctant to do, right? These are people that are not on Wall Street writing investment research. They're very reluctant on giving that strong buy rating. It's almost the outperformance of that strong buy rating from them also showcases over Wall Street analysts the conviction behind these stock picks. And I mean, it just speaks volumes to me. I see the quant rating system say strong buy. I see Seeking Alpha analysts say strong buy. Makes me feel a little bit calmer about the pick.
I think that's I love that as well. And I call it, if I have a stock that I find where it's a strong buy across all three, the contributors, Wall Street, and quant, I call that the trifecta. And rest assured, of course, no system is perfect. But if you find a strong buy coming from all three independent sources, that really does give a stock a lot of validation. And you usually do get performance better than the S&P 500. I would say that. So it's really nice. And we actually have on our screener a tool that will show you the stocks that has a strong buy from all three. That's called top rated stocks. So really awesome highlight there, Daniel. And I'm going to go back to the slideshow and enlarge it for those who are on their phone so they can see it. And taking us to the number 3 income-oriented stock is OneMain Holdings, ticker symbol OMF. This company has a market cap of $6.72 billion. Within the financial sector, it ranks 25 out of 683 stocks. And within its industry of consumer finance, it ranks 3 out of 38. This company has a yield of 7.36%. They provide personal loans and credit products to non-prime oriented customers. So, typically you will see periods of concern when the market is rotating to safe haven stocks. Stocks like this could pull back. Typically, with the rate environment that we've seen, which is, expecting rate cuts and then not expecting rate cuts. Financials, as I showed you on that table earlier, worst performing sector, they could get pretty hard. But if we take a look at OneMain Holdings and I go to the platform, you'll see the stock is actually up today. So it has definitely pulled back in the last few months. So if we look at the last 6 months, it's actually up. We look at the last month, it's up 3.64%. We look at the last 5 days, there we go. Stock has pulled back over the last 5 days by about 5.48%. And I would definitely view that as an opportunity. If you look at the factor grades on it, from a valuation framework, it is extremely cheap versus the sector. The growth is very strong versus the sector. Company is very profitable. So really, I'd say over the year to date, the stock is up 10%. Not really a major move. That's actually has underperformed the S&P 500. So a wonderful opportunity. If we take a look at some of the growth grades, we will see sort of a mix between good and bad. We can see the year-over-year revenue was fairly strong versus the sector. Revenue going forward is in line with the sector. If we look at EBIT, which isn't commonly looked at with a lot of financial stocks, you can see its growth rate is 4.65, which is under the sector. But if you look at the EPS diluted for growth, it's at 14% versus the sector at 10%. So I will tell you, even though you see a bunch of underlying metrics here, we actually do not equal weight these metrics. All the metrics are back tested. So some carry a higher weight than others. Hence, if you look at this report card, you might say, oh, it's kind of all over the place, but it gets an A- overall. And the reason being is that we place a higher weight on the metrics that have more of a predictive factor. So I will tell you, the EPS for long-term growth rate estimate of a 3 to 5 year CAGR at 21, almost 22%, it gives it an A versus the sector. So that's a 91% premium to the sector. That is definitely a very predictive factor, and that helps to nudge up the overall growth rate. So the valuation looks great, growth looks good, profitability for the most part looks really good. You're seeing B pluses, A's, a couple poor scores there, but importantly, that overall grade is a B plus for profitability. So for a company that's relatively small within the finance sector, we are very comfortable with it, and the dividend safety grade is an A-. So as we look to dividend safety, you'll see the dividend payout ratio is a bit on the higher side. That's why you have the D's. But some of the metrics that are important, free cash flow yield to dividend yield ratio, dividend coverage is on the lower side. You'll see it's a financial institution, so your debt to assets will be pretty high. But other items like the net income margin, return on equity, and really importantly, cash is king, cash from operations and cash per share definitely score well. So you could feel pretty comfortable in that dividend, especially since cash per share on hand is $5.56. Hence, it gets the A- dividend safety grade. So I'm going to take us back.
Steve, real quick, if you wouldn't mind going back to that symbol page, because this is what I wanted to showcase. Maybe we can show everybody where you're clicking as well when you click on the Quant Rating Beat the Market link, just so anybody that wants to go look at the back testing of the quant rating, it's right here on the symbol page. Quant Ratings Beat the Market. You're going to click on that. But I would love it if you could click on analyst ratings at the top. And this is what I wanted to showcase back on the other page with the REIT. But if you scroll down just a little bit, you'll see Seeking Alpha analyst strong buy versus Wall Street analyst strong buy versus the S&P 500. And you can see pretty much year over year, Seeking Alpha analysts, when they have that strong buy rating grade in aggregate, it usually speaks volume. They don't just give it out willy-nilly. That's one thing I wanted to highlight is the conviction of our analysts here on Seeking Alpha in correlation with the quant system that you've developed over the years can really help guide you to those stock picks with great fundamentals, with potential catalysts coming down the line as well, with maybe great management teams. I mean, it all kind of comes together right here. So thank you for taking a moment to highlight that. I just wanted to show everybody that.
Yeah, and I will add, our contributors are really good. Wall Street analysts serve a function for the Wall Street firms that they work for. They want to make sure research is provided on companies where they've done investment banking or in hopes of doing investment banking, or for big trading desk. There are other motives that are oriented around Wall Street analysts. And when you look at our contributors, they're just looking to pick stocks and pick the right stocks. So I think when you look at this is going back 5 years. The Seeking Alpha contributors, the performance is up 115% versus Wall Street up 33%. So hats off to the Seeking Alpha contributors for doing such a great job. So really, between the quant and Wall Street analysts, you almost don't even need the Wall Street rating there for that trifecta. But if you have a buy, or a strong buy from both the quant and the contributors, you're in really good shape. So I want to take us back to the platform. We covered our 3 dividend stocks. So now we're going to move to our 3 AI growth stocks. And, these are companies that have done well, extremely well over the course of the, last 52 weeks, if not longer. And some of them have had a pullback recently. And that's why I want to focus on these names, because the fundamentals are still incredibly strong. People talk about AI potential bubbles being overvalued. With these stocks that we're bringing forward, we think the valuation framework is attractive on all 3 AI stocks, and we think the growth is attractive. That's why we think this is a wonderful opportunity to take advantage of the dip. So Micron Technology, ticker symbol MU, one of the largest in the world, has a market cap at $271 billion. Within information technology, it ranks number 1 out of 538 stocks. And within the semiconductor industry, again, this is from a quant rating perspective, it ranks 1 out of 67. It is the only US-based manufacturer of advanced memory chips that are vital to cutting-edge technologies, including AI systems and high-performance computing. It has a forward EBITDA growth rate of 60%. Its EPS diluted growth rate is 144% versus the sector at 12%. It has $17.5 billion in cash from operations. And analysts remain very positive on this stock. In the last 90 days, 29 analysts have taken their earnings estimates up and 0 have taken it down. And I'll take us to the platform.
I'll also mention that just a few days ago, Samsung Technologies, which is a big competitor of Micron, announced that they were raising the prices, I think it was by 60% on their memory chips. So that's why I think you've seen a recent rally in Micron, and we'll see what happens in the market.
All right, so here, as you can see, the stock has had like a stellar year. It's up 138% in the last 52 weeks. Year to date, the stock is up 173%. But we've noticed in the last 5 days, the stock has pulled off about 5%. Today, it's down about 4.73%. So a little bit of weakness there, but just some really positive news overall for the industry and the valuation. And it's hard to find IT stocks that have attractive valuation grades and good growth rates at the same time. And that's something I really love about this. So if I click on valuation and we're comparing to the IT sector, you can see the forward PE that has an A-, and the reason being that the multiple is only 14 times versus the sector at 22 times. So it's a lot cheaper than the sector. If we look at it on a PEG basis, again, one of my favorite metrics because it combines both growth and PE, its multiple is 0.22 versus the sector 1.66 times. So from a valuation perspective, it's at an 86% discount to the sector on a PEG basis. And some other metrics look really good too. EV to EBITDA, EV to EBIT, price to cash flow, Lots of good metrics. Not much of a dividend yield. That's why it's got an F for there. But we don't really need our IT and semiconductor companies to be providing dividends. We want to see them growing. In terms of profitability, very, very profitable. You can see the EBIT margin comes in at 26%, EBITDA margin at 48%, return on total equity better than the sector. You can see the ROE is 17% versus the sector just under 6%. And you can see that the return on total capital is about 9.5% versus the sector at 4%. So company is very profitable. If we look at momentum versus the sector, and again, really when you look at momentum, we're not looking at it in absolute terms. We're looking at it compared to the sector. And you can see this is a straight A report card. If you go back 1 year, the stock is up 151% versus the IT sector, not up even 2% over the last 52 weeks. If you look at the 6-month performance where it gets an A+, you can see it's up 146% versus the IT sector up only 2.8%. And in the last 3 months, the stock is up 100% with the sector down 2.4%. Now, you might say to yourself, I really don't want to chase a stock that has had that kind of move year to date. If you look at the factor grade card here and you look at the valuation framework, the grade down it now is a B-. 6 months ago, it was actually more expensive. It had a D grade. So the company now, despite in the last 6 months being up 135%, it actually has a better valuation framework now than it did 6 months ago. And the growth remaining at A+ territory, very strong, profitability very strong now versus the last 6 months. But from a valuation standpoint, it's actually more attractive now than it was 6 months ago. So that's one of our AI-oriented stocks that we think you should be looking at. The second one, definitely a lot smaller than MU, is CommScope Holding, ticker symbol COMM. Market cap on this is about 3.6 billion. Again, as a quant strong buy. Within IT, it ranks 2 out of 538 companies. And within its industry, communications equipment, we rank it number 1 from a quant perspective out of 39. They're a global leader in providing infrastructure solutions for communication, data centers, and entertainment networks. So obviously data centers, I'm sure most investors are very familiar with the growth and the expansion that we've seen in data centers. So CommScope Holding provides solutions for them, hence one of the reasons why the stock has done so well. You can see its cash per share is tremendous at $3.18. So that puts it at a 42% premium to the sector. Analysts very positive on the stock in the last 90 days. 4 analysts have revised their earnings estimates up and 0 have revised it down. EBITDA margin is 23% and levered free cash flow margin is 28%. So that's CommScope Holding. We'll give you a quick picture of it on the platform. And you can see the stock has been fairly flat for the last couple of months. Over the last month, it's up about 7.5%. Over the last 5 days, this one is well down a little over 5%. And that's what we want to take advantage of. And you can actually see the stock is up about 1.15% today. Despite the stock in the last 6 months being up 185%, the valuation framework is very similar now to where it was 6 months ago. So it has not gotten expensive. The growth has deteriorated a little bit versus 6 months ago, but it's still very strong. And I will show you that. We'll click on the growth card and you can see the forward EPS growth is 42% versus the sector at 12.3%. If we were looking at why it's a little bit lower, the growth, you can see if you look at the EBITDA growth, year over year, EBITDA growth was 89%, and the forward EBITDA growth rate is 14.9%. So EBITDA growth definitely a lot lower than it had been over the course of the year, but still significantly stronger compared to the sector, and hence one of the reasons why it is still a strong buy. And again, it's really on a sector relative basis. We don't look at these in absolute terms, and it looks great versus the sector. Going back to our slideshow.
Not to mention also the profitability grade has also improved over the last 6 months. I know that's one that you didn't touch on.
You know what? That's a huge improvement. Really good highlight there. Profitability now an A, and 6 months ago it was a C+. So perhaps that could be one of the leading reasons on the stock's rise over the last 6 months is the improvement in the quality of the company. So I'm glad you mentioned that, Daniel. And going back to the slide deck, we'll enlarge it. So for our sixth and final stock and our third AI stock, we have Celestica, ticker symbol CLS. This has a market cap of 35 billion. Within IT, on a quant basis, it ranks 5 out of 538. And within its industry, which is electronic manufacturing services, it ranks 1 out of 18. This company provides engineering services, component sourcing, electronic manufacturing across defense, industrials, and communications and enterprise market, including, of course, data centers and hyperscalers. And that is one of the reasons why the stock has done well. It's because there's been so much demand for their services. On a PEG basis, it's at 1.3 times. So it puts it at a 19% discount to the group. And the forward long-term growth rate, the 3 to 5 year CAGR, is at 39%, which puts it at 155% premium to the sector. Good profitability, ROE at 37%, cash from operations at 552 million. And analysts continue to be positive on the stock, with 13 analysts taking their earnings estimates up in the last 90 days and 0 taking it down. I will bring us to the platform so we can look at the stock. And you can see that the contributors and both Wall Street have a consensus buy in it. Quant continues to rank it as a strong buy. And as Daniel mentioned earlier, this company as well, with the quality of their business, we see the profitability grade at an A now versus just 6 months ago where it was C+.
Steve, real quick, wrong
Sure.
symbol. Go over 1 tab to the right.
Oh, sorry. Celestic, you're right.
There you go.
All right. And you can see, so the valuation is a little bit more expensive here. Thank you for highlighting that. So it's a D now versus C minus. Not much of a change, really. That's like barely a change at all in the last 6 months. And you can see the stock is up 175%. So the valuation framework has barely changed on this stock, despite it being up 175%. So you could feel comfortable when stocks make moves like this. If that evaluation framework is similar to where it was 6 months ago or a year ago, you can feel very comfortable with the growth. And here you will see the growth now is A minus versus 6 months ago, a B minus. So that's a full grade. That growth has improved in the last 6 months. Profitability is now B versus C, and analysts continue to be very positive on this stock. I will also say, Daniel, this stock was one that we had in Alpha Picks, and I'm going to change the platform. I'm going to go from the premium platform to the Alpha Picks platform. And I'm going to show you this is the performance of our stocks in Alpha Picks. And you can see Celestica, it has done so well that we actually had to reduce the weight of the position because it was over 15% of the portfolio at one point. So we had to cut it back. But even with a position that's still open, it has provided a return of over 1,000%. It has absolutely crushed the S&P for the same period. You can see one of the other stocks that has done well, and we had to partially close that position because at one point that became more than 15% of the portfolio. That stock, AppLovin, was up 1,500%. We no longer have this stock, Supermicro, but we freaking nailed it. That provided us a return close to 1,000%. And you'll see Pal Industries, another stock that has done well off of data centers and the demand, is up 492%. So I'm not going to show you the entire Alpha Picks portfolio, but you can see if I ranked it by returns, we have had some huge winners for Alpha Picks. Since inception, Alpha Picks is up 248% versus the S&P up 76%, and that's about 3.5 years. Year to date, Alpha Picks is up 34% versus the S&P up 13.5%. I'm going to take us back to our presentation. So those were our stocks, 3 for income to take advantage of. You can see the top income stocks boast an average forward yield of 5.93% versus the S&P 500, which has a yield of about 1.1%, and the VIG, which has a yield of 1.61%. So the yield for those 3 stocks far higher than both the S&P 500 and the VIG. Again, all 3 strong by quant ratings and dividend safety grades in very good territory. Our top AI stocks have returned on average year to date 213% and maintain excellent EPS revision grades, as well as really solid valuation framework for the most part, really strong growth grades. So we would encourage you to take advantage of this recent dip to buy both income-oriented stocks and to buy some top AI stocks. And like I said, you're seeing in the news every day, people are fearful of the AI bubble. Some of them have really come off a lot. But these stocks that we have recommended, we now have very strong fundamentals. I am going to be writing an article, which will be out tomorrow at 5 a.m., which will review what we covered today in our webinar, top income and growth stocks worth watching. So that's going to go out at 5 a.m. And when you see that article, feel free to follow me, and you'll be able to get all my articles that I produce. And Daniel, I think that's about it from the presentation. Perhaps you want to tell people a little bit more about Premium and Pro and Alpha Picks.
Absolutely. So, Steve, first off, thank you so much. I mean, 6 names thrown together, whether you're looking for capital appreciation or you're focused on income in aggregate, that yield is definitely going to be better than what you get just holding the S&P 500 there. So thank you for that. And as you mentioned, everybody go follow Steve's author profile. It's free. You get all of his coverage sent to your inbox. I mean, that's just an amazing give back that you do for the community here and Wall Street and investors worldwide. So what are we looking at here? Black Friday sale. So I can't tell you how many people throughout the year are always asking me, when are you going to have a sale? When are you going to have a sale? When are you going to have a sale? Well, I'll tell you what, we saw the government shutdown in, and so we threw a sale. No, I'm just kidding. Black Friday sale right now, 20% off all products here on Seeking Alpha. Whether you're looking to sign up for premium for your first year, typically it's $299 a year. We'll just drop down to $239 for that first year. Alpha Picks or Pro, let's dive into some of those. So Alpha Picks, as Steve showed you a little bit of the platform earlier, that's 2 stock picks every month. That's 20% off right now as well. And that's typically $499 for the year. Currently, it's running for $399 for the first year, so don't miss out on that. Or maybe you're looking for something higher level, something more active. Well, we recently this year unleashed the Pro Quant portfolio, and we'll dive a little bit more into these portfolios in here just a second. But Seeking Alpha Pro currently is 20% off as well at $1,920 for the first year. It's typically $2,400 for the year. Now, people go, okay, you kind of give me the numbers, you kind of give me the product, the subscription tiers. What do I get in each one, right? So, Steve, why don't we go ahead and go to the next slide and we can start walking through. So, Seeking Alpha Premium is a lot of what you saw today in Steve's presentation. It's going through the portfolio. You get access to the quant system. You get access to the financials. You get access to SEC reports. You get access to those dividend grades on those stocks, the advanced screeners. All of that is inside of Seeking Alpha Premium. Not to mention the internationally world-class top-tier Seeking Alpha analyst community and all of their coverage. You can build your own portfolios. There's a health check there. Everything that you've seen today is within Seeking Alpha Premium. Also, so let's talk about Alpha Picks. Well, what is Alpha Picks? Steve, go ahead and go to the next slide for me. So Alpha Picks is the 2 stock picks every single month. It's on the first trading day of the month or the 15th trading day of the month. And if the 15th is a holiday or the first is a weekend, it's that next immediate trading day. Now, who is this for? This is for that person that's like, I don't have a lot of time, or I need a little bit of help, or help me find those great ideas. How do I put a portfolio together? Alpha Picks is something you're definitely going to want to check out. And I'm going to go ahead and ask the team in the back. Can you go ahead and drop the link here in the chat? And if you're watching the replay, go ahead and click the link below the video, and you can learn more about each of these products yourself. But as you see there, the returns from this portfolio, Steve, I remember when we launched this, and we were all like, man, this is new. Like, is this risky? But the quant system approach, the systematic approach of when to buy, when to sell, when to trim the portfolio has definitely worked out. And I can't congratulate you and the team enough. I mean, you guys have
Thank
been
you so much
on top of it. You're there for the community. You're always engaging in the comments. You're showing, you host those webinars multiple times a month, helping people understand why the picks are put into the portfolio, how they were highlighted by the quant system. Very, very cool what you have done with Alpha Picks. And let's talk about Pro a little bit as well. So if you wouldn't mind going to the next page. So Seeking Alpha Pro, people are like, what do I get with Seeking Alpha Pro? Well, we can talk about the Pro Quant portfolio, which was launched in June of this year. This is for that more active investor and trader. This is on average 2 to 3 stock picks every single week, every Monday, that goes in and out of this portfolio. Sometimes there's no trades at all. Sometimes it's 6 or 7 trades on that Monday. So it's for the more active investor, but the portfolio is limited to 30 positions, and it is rebalanced every single week as an equal weighted portfolio. And Steve, I mean, you're seeing great returns already in these last 5 months here. I can't wait to see where this one goes in the years ahead. And we'll talk a little bit more about Pro because, Steve, there was actually a question in the chat, and I want to highlight a new feature that has recently been released to Seeking Alpha Pro, and that is Ask Seeking Alpha. That's the newest AI feature that got launched on the search bar that helps you with your investing research. So we'll jump into that in a second. I will show you that because I think it's really cool with what this person has asked you in the chat here. So that's the Pro Quant portfolio. So multiple products. Which one's for you? Steve, next slide, please. Here's the breakdown. Alpha picks versus Pro Quant portfolio. You get 30 equal weighted positions in Pro. You get 2 new picks for Alpha picks. The rebalance frequently, weekly. You get access to different stock universes. If you're looking for a share price minimum or a share price maximum, each product has a different for that, as well as if there's anything around shaky business with management, Steve and the team are always on top of it. So you always know that they have your back, no matter if you're with Alpha Picks or the Pro Quant portfolio. So highly encourage everyone, please go check those out. Like I said, special time of the year, because people are always asking me January, February, March, all through the year, when is Seeking Alpha going to run a sale? Well, the time is now. The time is now. So this is going to not last forever. So I highly encourage everybody to go click that link, check it out. Let us know if you have any questions right now in the chat. I am ready here with Steve to answer your questions about the products that we're showcasing here today. We want to make sure that you understand how each of these work, but they are systematic approaches based off of the quant system. And Steve's team is really on top of everything that you guys need. So Steve, did I leave anything out?
How about
the
this?
bundle. I forgot about the bundles. Oh,
Yes.
I forgot about the bundles. So this is cool.
This is what I always recommend to do.
This is what people have been asking for a long time. They're like, I want premium and I want to research my own stocks, but I also want Alpha picks. The team at Seeking Alpha finally has this bundle put together. So if you want both premium and Alpha picks, you can check that out as well. It's a cool starting point, if you will.
I've been asking for this for a long time for people, Daniel, because you've had to buy both of them separately. And I think the two of them together make so much sense, because the premium allows you to do your own research and then follow also what's in Alpha Picks, where Alpha Picks is a platform that we provide you with a research, we show you the performance, but it's just on the Alpha Pick stocks. And if you have stocks outside of Alpha Picks, or you want to really monitor the Alpha Pick stocks closely, you need to have premium. So that's why I've been asking for so long. Can we do something where we bundle both together? And they have finally done it.
Yeah, this is great. And if anybody has premium already and you want to switch over to a bundle plan, you can always reach out to subscriptions@seekingalpha.com and they can assist you with transitioning into a new plan such as this one. So it is definitely one of those highlights. And it's also a great gift for people. I'll put that out there. You know, the holidays are coming up. You might be looking to what you want to give somebody. So check it out. But that's enough for me. Well, I mean, I just had to get that plug in there because, as I mentioned, people ask me all year long, when are you going to run a sale? So we want to make sure you don't miss it. Okay, Steve, we got some Q&A to go through.
All right, let's do it.
The first thing I would love to do is if you could go to the Seeking Alpha platform.
Sure.
Because it's about one of today's picks, the income pick as well. So go up in the search bar. I want to highlight this to people because there was we recommended Merck today, but somebody highlighted in a recent webinar, you also highlighted Pfizer a while back. So if you can go up into Ask Seeking Alpha AI and just type the words compare and then put MRK and then write and PFE.
Which one?
PFE, Pfizer. And go ahead and hit enter for me. We're going to showcase this new AI product that was released to all Seeking Alpha Pro subscribers. This is the additional value you're getting outside of premium as well, including, you get everything else that premium has. You have the Pro, so Seeking Alpha Pro has a Pro Quant portfolio, but you also have all the screeners. You have the Seeking Alpha Quant system. You have
this is very cool.
Top analyst ideas. All of that's in the left nav bar there. And boom, right here. Look how quick that was. Can we talk about how quick that was? So you can compare stocks side by side. You can do multiple stocks if you want, but this is going to help you research what stock you're trying to invest in quicker. So hopefully I apologize. I forgot who asked that question here in the chat. Hopefully this helps. If you have something like this, an AI investment companion in your back pocket, that is Seeking Alpha Pro, and that is Ask Seeking Alpha there, one of the newest AI features here on Seeking Alpha. So thank you for taking that out of the way for me. Let's dive in to all of these great questions that have come in today. All right, so first one first. We went through all the symbol pages and people were asking about the quant rating system and the metrics. And for example, one question kept coming in is we have the 5-year averages next to a lot of the metrics across valuation, growth, profitability, revisions, momentum. Why look at the 5-year average was the question.
Yeah. So the 5-year average, I'll pull it up for, say, valuation, and we're on Micron Technology here. So what we try to do when we assess stocks from a quantitative standpoint, uh, really for us, it is comparing a company's metrics relative to the sector. And that lets us know if it's cheap, if it has stronger growth, if it has better profitability. However, another metric, that is widely used is people do like to see how a company stands now versus how it looked historically. So if we look at PE on a forward basis, we could see Micron has a forward PE of 14.3 times. The 5-year average for Micron was 75 times. So it is significantly cheaper than where it was historically to its 5-year average. And actually, I didn't even look at this number. So you're just bringing this up now. That's incredible. So not only is the stock cheaper to this sector, it's also cheaper compared to its 5-year average, which is amazing. Now I want to take a look at the growth rate for it and look at the same thing. So we know if we're looking at EPS growth, the EPS forward growth rate now is 143%, which is just mind-boggling in itself. So we know versus the sector, it's huge, the premium, because the sector only has 12% growth. But if we look at the 5-year average, the 5-year average growth rate for EPS was 16.21%. So the company is growing far, far faster than it did historically. So we know compared to the company's own average and compared to the sector, the growth is far more attractive than it was. So more attractive on growth, more attractive on valuation framework as well. So that is one of the reasons why we'd like to show the 5-year valuation, so you can get a sense of where the company is in absolute terms, where it was historically. So we'd like to look at it relative to the sector. That's really how we make our decisions, but it's great to have that view of how it looks historically as well.
All right. Thank you, Steve. We got a question here. I think maybe we had said it, but just to make sure that we get it clarified, how often does the Seeking Alpha Quant system run and update these grades?
Every single day. And really, that's the main difference between what we do and what a professional analyst does. A professional analyst is only going to be able to sort of review their stocks a couple times a year. There's no way they have really the bandwidth to compare it against all stocks to the sector on a daily basis. And they don't issue research reports. That's obvious on a daily basis. You're lucky, for per company that you can get one research report a month. That's the beauty of quant. We assess it every day. So we're looking at the balance sheet, income statements, cash flow statements, and hundreds of metrics, and taking that data and comparing it to the rest of the sector. And that's what determines the factor grades. So that's how you get that instant characterization of how the company compares to the sector. And it gets refreshed every morning between the hours of 4 a.m. and 6 a.m.
All right. We got a question from Michael over here wondering, why do you just focus on comparing these metrics to his sector peers and not the greater general market?
Well, great question. So, when we look at the overall quant ranking, we can see how the company does compare to most stocks. So we have about 4,300 stocks in the quant universe. That's most investable stocks for the most part. Keep in mind, like you have the S&P 500 or the Russell 2000 or 3000. So there's a lot more stocks that we're looking at in our system. And you can actually see where each stock stands versus the overall market. But when it comes to making an investment decision, I want to make sure that the company is doing better than the rest of the sector. And that's, sort of the benchmark that we use is that sector comparison. But we do show where it ranks overall versus all stocks.
All right. Thank you for clarifying that. Now, there's always the question we get when we do webinars like this about stock picks is, how long do you hold the stocks for?
As long as the quant rating says strong buy or hold, we hold it. As soon as that trade changes to a sell or a strong sell, that's when we sell it. And people often ask me, if a stock drops to hold, do you sell it? And I'm like, no, we don't. And in fact, with alpha picks, we have a rule that if a stock does drop from a strong buy to a hold, we actually will keep it in the portfolio for 180 days as a hold, because we believe, often stocks can continue to move even though it has a hold recommendation. Sometimes in our system, the value grade could drop from a D to D minus, and that's the difference between a strong buy and a hold. But the growth rate still stays strong, so we're like, it's well worth holding on to these stocks.
All right. There's been a question about Alpine specifically, and if you're comfortable with the level of debt that they hold on their balance sheet.
Yep.
It is a
So
REIT
let's.
after all.
One of the great things is you can see that a lot of the financial data in two ways. You could either go to financials and you could dig into that, or you could scroll down and you can actually see how the company looks. So you get a really great picture of earnings revisions, valuation, growth, profitability, momentum, capital structure, dividends, trading data, data history, where it is versus the peers. And I want to show you, like, I know if we go to the dividend safety, we will see things like interest rate coverage, then we'll see total debt to equity, total debt to capital. So those are some of the leverage. We have net long-term debt to assets. So you can see at C, okay, these C grades means it's really in line with the sector in terms of debt to assets and debt to EBITDA. In terms of debt to equity, it's at the D plus level. Although that grade is a D plus, we're not looking at a D minus or an F, so we are comfortable with it. The dividend safety grade is C plus, which is sort of just on the fringe of what we feel comfortable with. So this company should be able to maintain its dividend, and that incorporates the leverage levels and the debt levels as you see here. So that makes us feel comfortable. As I said, you get that sort of instant characterization where it is versus the sector. So at C minus, D plus, it's really sort of in line with the sector.
All right. Why don't you do me a favor? Head over to the Celestica symbol page for me.
Sure.
There was a question here. So click on the quant for me, the quant rating, the strong buy, where we can show the historical quant system rating grades for every single day going back.
Yeah,
right.
very transparent.
So, very transparent. The question was, why does the quant rating system flip to a hold, like from November 5th to November 10th, and then back to strong buy? That was the question.
Right. So you may recall I just mentioned this is a data-driven process, so there are thresholds. And when a threshold is triggered, usually a grade will change. So on this particular date, from November 4th to November 5th, we saw the valuation go from D to D minus. And for us, when something gets to be a D minus, that's indicating that it's kind of expensive at that point. And it's a default of the system. It's sort of like a circuit breaker. If it goes from D to D minus, that's when it will flip to a strong buy. But being that we're measuring these stocks every single day, the price is being incorporated every day. The valuation metrics are being incorporated. The growth is being incorporated, and it's incorporated versus the rest of the sector. There's a lot of moving data points. So on this particular day, that valuation grade dropped to a D minus. And then the next day, it actually went back to D. And people will say, why does it go back and forth? And it's, well, stocks trade every single day, thousands of times, thousands and thousands of times a day. And with each trade that occurs, that is a new vote on the valuation framework and the growth framework and the profitability framework for a stock. And that's what a data-driven system does. It's not an emotional system. We're not listening to talking heads. We're not listening to management teams. We're not listening to analysts. We're purely looking at the data and where it is. And that is a systematic trading system. And as you can see from our back test and our real performance, it has performed very, very well. So difference here, D to D minus brings it to hold. Then after being at a hold at a D for a couple of days, it went back into the strong buy territory. So, but if it does go to D minus, that will trigger a stock to go from a buy or strong buy to a hold.
All right. I do need to make a quick clarification because I saw a couple chats here. Alpha Pix is not included in Premium or Pro. And Pro, if you have a Pro subscription, you have everything in Premium already. I just want to make sure we clarify that. So there's the Premium and the Alpha Pix bundle. Alpha Pix being a separate product. You can buy Alpha Pix by itself. You can do the bundle with Premium. Premium is a set-alone product and Pro is a set-alone product, but Pro includes everything from Premium, but not Alpha Pix. Just want to make sure I clarified that. Thank you for
right. So Pro has the Pro Quant portfolio. It has top analyst ideas. It has upgrades and downgrades. It has exclusive coverage. It has short ideas. So there are a number of things available in Pro that you do not get with Premium. And it really, those items in Pro that you get really help to generate alpha. And when I say generate alpha, it gives you the ideas that will help you benefit more than just going into the market. And that's why it costs a little bit more, because it's so focused on alpha generation.
Steve, I'm gonna put you on the spot for a moment,
Yeah,
if you don't mind, because there's a question here about how to like use certain parts of Seeking Alpha. So why don't you jump over to a screener maybe for us, and
sure.
maybe you can walk us through a quick screen and showcase how the quant rating system's there, how we have all the metrics. You can filter that as well, and we can give people a little bit of taste of what the premium and pro offering is here.
Definitely. So on the left-hand rail here, I'm going to scroll down, and you can see most normal people just have like one or two or three portfolios. I'm a portfolio junkie, so I create portfolios around themes. So that's why you see all these different portfolios. And you can see a lot of them. The market has come back nicely today. After a couple of down days, I think the market's starting to rebound, as we can tell by some of these portfolios. But in terms of the screeners, if we go all the way to the bottom of the left-hand rail, we'll see stock screener. And something that we mentioned early on that both you and I like, Daniel, are stocks that have that strong buy from all three research sources, from the Seeking Alpha contributors, Wall Street, and Quant. So we actually have a pre-made screen called Top Rated Stocks. And if you click on that, it will give you all the stocks, and there's not a lot. The quant covers like close to 4,500 stocks. So out of the 44,500 stocks, only 43 of them possess a strong buy from quant, Seeking Alpha contributors, and Wall Street. And this would be the group of stocks right here. So, and happy to say Micron Technology, which we recommend today, is the number one stock on that list. And number two, and I did not know this, Daniel asked me to bring this up, the number two stock is CommScope Holding, which we also recommended. So really cool to see that.
Yeah,
Merck is
thanks
on
for
this list
highlighting
as
that.
well too.
Yeah, a couple good names there. I do want to highlight there was a question that was asked about Ask Seeking Alpha that is only included with the pro subscription. However, there are AI features such as the earnings call transcript or insights, sorry, earnings call insights, which is also included in your premium tier. What that pretty much does is it takes the earnings call every quarter and kind of compares, it summarizes it first off, but then also compares things like management's tone and the words they use, and really gets into like the nitty gritty and compares it to what they were saying previous quarters, and if it was validating or invalidated, or is there any worry, or how did analysts come off in their messaging and their tone. Like really cool insights given there with the AI for the earnings call insights. So you can always check that out as a premium member as well. Here we go. See, going back to some of our questions over here. What is our source for the metric data? Was a question that, like, where are we pulling our data from for the quant system?
S&P Global. Yeah, and I think you highlighted that earlier in terms of our monitoring our performance, and the back tests that we have as well. That all gets verified through S&P Global and an application that they have. So it has that independent vetting to it, and the data comes from S&P Global as well.
All right. Now, I thought this one was interesting. Does the quant system utilize any technical analysis?
It does not utilize technical analysis per se, but we do have a momentum grade, and it is sector relative momentum. So I can actually click on Micron here. If I click on momentum grade for Micron, it'll take us right to that. So it is a certain form of technical analysis that is used by individuals when you're looking at relative performance. We just look at it from a different perspective. So it's not really technical analysis per se, and we don't incorporate any other technical metrics, but we do have momentum in there as a factor. And it's a very important factor. Yeah, if you actually looked at all the factors and all the metrics that we have, and valuation, growth, profitability, EPS revisions, and all the underlying metrics, there is empirical data that will go back over 200 years that shows you the momentum factor is one of the most important in terms of future stock price predictability.
All right. And to recap as well, as you mentioned earlier, each of the 5 factor grades have their own proprietary weighting, which goes
Correct.
into the quant rating that is provided overall. I want to make sure everybody clarifies that because that's a question that comes up all the time. People are just like, oh, it's 20%, 20%, 20%. No, it doesn't work that way, right? All the back testing that Steve and his team has done is definitely reflected within the rating there. All right, let's see here. I think we covered a lot of these today. I mean, 3 income names. You had Merck, you had Pine and ticker OMF. And then, of course, we had Micron, Celestica, and CommScope today. Everyone, thank you for taking the time to hang out with us. Steve, is there anything that you would like to highlight? I've got one more spiel, but I was going to let you say anything else before we jump
Yeah.
off.
Well, first and foremost, I just want to thank you for organizing this today. I think the timing was great that we had this market dip and we had the opportunity to recommend stocks that have yield and some top AI stocks that have really good fundamentals. So taking advantage of that market dip. One question that often comes up is when we show the performance, part of it was a back test, and that's really from 2010 to about 2019. But after 2019, going into like 2020, these are all the simulated trades that have occurred. And you can see it is absolutely a great track record. So when we look at the last 5 years, that's not even a back test. That's the actual simulated trades that have occurred. Looking at the strong buys every single day. So I think great platform for premium overall. But really, if you want research that's been vetted and you're looking for our top stocks, we do that through both Alpha Picks, which gives you the 2 ideas a month. If you want ideas on a more frequent basis, there's PQP, which rebalances weekly. So on average, every week, it gives you 2 to 3 ideas. Some just great tools to really take advantage of our quant system. That's it from my standpoint, Daniel. Thank you.
Yeah, and I just want to remind everybody, site-wide going on right now, Black Friday sale. So whether you're interested in Premium, Pro, Alpha Picks, or any of the investing groups, even as well, all the investing group leaders that are on site, 20% off going on for a limited time. And who knows, by the time the sale's over, we'll be at all-time highs in the market again, right? Where it's not that much of a pullback, people. Let's keep that in
It's
mind.
not, right?
It's not that we're not in a bear market. Just what do we say? Keep calm, carry on,
Keep
invest.
calm, carry on, keep investing.
That's long. That's right. All right. Thank you so much, everyone. If you watch the replay, thank you so much as well. We're going to have that replay out to here soon. And everyone, we will see you in the next webinar. You can always find the replays on the Video Hub on Seeking Alpha. Just search for Video Hub in the search bar. I'll talk to you soon.